Ladies and gentlemen, welcome back to the channel. Stocks are quote unquote crashing today. Is this just a part of September seasonal weakness that we should expect, as we talked about over this weekend? Or is this the start of something worse? As I talked about over this weekend, you really have to not look at the market's reaction this month. Because, again, you could have a really bad day that's really not bad. Just stocks react bad to it. Is this one of those days? Or did something fundamentally shift that you need to know about? We'll get into that in this video, and I will give you all of the information you need to know and all of the breaking news today. Ladies and gentlemen, hit that like button, subscribe to the channel, and check out that link down below in the description of this video if you want to come trade alongside myself and over 100 members in the trading community, where we are going out and investing in small cap AI stocks before Wall Street even knows about them. And yes, we are outperforming 98% of hedge funds and institutions year to date, but keep in mind that is not financial advice. Read the disclaimers before you sign up, but that link is down below in the description of this video if you want to check it out and come join us. With that said, let's get into today's episode. Okay, now let's get into what is actually affecting markets today, why stocks are selling off. Okay, so it's a little bit weird. There's multiple different things going on today. Again, the Dow is down 0.88%, S&P is down 1.11%, NASDAQ down 1.34%, Russell 2000 down 1.1%, and the VIX up 13.28%. People are just hedging, again, because it's September, and there's a lot of indiscriminate selling from the algorithms, as we've talked about, okay? But there's really a couple different things going on today. First and foremost, I think one of the biggest things is Trump's tariff loss in court. Okay, this article goes over what it means for shippers and the billions in trade duties collected by the U.S. government. So, okay, here's the deal. Remember when the big beautiful bill was passed and the bond market freaked out for like 2 days and bond yields went up and people were like, oh my gosh, what does this mean for the longevity of the government and, you know, higher deficits and more borrowing, and oh my gosh, what a problem. Well, that kind of went away because Trump and his tariffs were going to offset some of that. Now, is it really a big deal whether the deficit is $2.5 trillion or $3 trillion? Not really. Okay, as Tom Lee has talked about before, the United States balance sheet is basically untapped, right? Like a lot of countries have nationalized parks and industries, and like just think about how many like projects are out there, how much resources the US government owns just by being in America, right? That is kind of untapped. Like, is that sustainable? No. But is there any immediate like bankruptcy concerns? No. Okay. But on the flip side of that, you could make the argument, which is the logical one, that if we don't have tariffs as large as we thought, we're not going to have this quote unquote inflation problem. I think this is the Wall Street perspective, because I don't think we're going to have an inflation problem either way, whether we do have high tariffs or not. But from a Wall Street perspective, smaller tariffs mean less inflation. They mean more cuts, a stronger economy. So does all of that get outweighed by a slightly larger deficit? Keep in mind that deficits, the larger they are, historically correlate to higher stock prices. Because again, a deficit is the difference between, you know, how much revenue the government is bringing in versus how much they're spending. So that means they're actually going into more debt. There's more money creation. More money creation leads to higher asset prices. Okay, so keep that in mind. Historically speaking, higher deficits have led to higher stock prices. Okay, but essentially what this does in the very near term, okay, is create uncertainty. And I think that's why the algorithms are selling off, because uncertainty. Now, it says here that the tariffs will stay in place until October 14th, until the Supreme Court makes a ruling on this. It says, quote, "Right now, we have not heard anything much or seen any changes," said Paul Bashir, vice president for global supply chain for ITS Logistics. With Trump's tariffs still imposed until October 14th and the expected appeal by the Trump administration, shippers are sitting tight. Quote, "Most shippers are awaiting the appeal to the U.S. Supreme Court and its final decision. There has been a lot of front loading as well, so impact for now should be minimal," he said, referring to the period earlier this year when imports surged as businesses loaded up inventory to avoid tariff effective dates. Besant said today he believes the Supreme Court will uphold Trump's use of a 1977 emergency powers law to impose the tariffs on trading partners, and the administration has a backup plan if it does not. Okay, like, long story short, it just, there's maybe some good and bad implications, but I think the good should outweigh the bad here, and the bad is really uncertainty. That's at least my take of this. Now, this guy says, quote, "Most companies will remain cautious with their forward ordering unless they see demand picking up." And I think this was really just the case anyways. Like, does this change how companies are going to order? Okay, no. Like, logically speaking, no. If you're a company and you're like, okay, 2 weeks ago or a week ago or 3 days ago, I thought I was going to pay XYZ tariff. Fine, great. You were going to order what you were going to order. Well, now today you're like, okay, maybe I don't have to pay those tariffs. Is that, you're still going to order what you were going to order regardless, just you may have better margins. Like, this doesn't change like how companies are going to order their products. If anything, it could make companies order more if the tariffs ultimately fall through. Now, here's a little bit of the change here. It says small businesses that use a third party like UPS, FedEx, or DHL brokers as the importer of record would face additional challenges. In these cases, the U.S. government would refund the third party, which must then create a process for refunding customers, according to Anthony. This could lead to significant delays for actual importers, even if the government process goes off without a hitch. But again, is this going to change how companies order? No. Like, you're either going to get a check back for the tariffs you've already paid, or you're not. Like, it's not going to cause a change. That's a crazy speculative jump to conclusions on Wall Street's part today. Like, I think it's actually pretty straightforward and simple. Like, this does not change the demand. Logically speaking, it shouldn't change the ordering from companies. Either you get a check back or you don't. Okay? You weren't expecting to get a check back. So if you do, great. That likely helps earnings. Okay? If we have less tariffs, then that helps earnings. That, logically speaking, should help the economy. We've seen Wall Street freak out over the past 6 months that tariffs are going to hurt the economy. Well, without as many tariffs, that should help the economy. We've heard Wall Street freak out for 6 months that tariffs are going to cause inflation, even though I don't think they're going to. If we have less tariffs, less inflation. And logically speaking, with less inflation, you have a greater justification to cut rates. That, I think, is the positive. The negative is, oh shit, this is happening in September, and it creates uncertainty. Wall Street doesn't like uncertainty. But is this actually a negative? Or are we just in a weird seasonal time where the uncertainty is clouding over the positive? That's what I would say as the bottom line conclusion. But today we also have another big story, and it's in the bond market, okay? With the tariffs maybe getting refunded, that means the debt burden's going to go up. That means there's going to need to be more issuing of bonds, okay? So more quote-unquote dilution in the bond market, okay? Justifiably, logically speaking, bond yields are going up, okay? 10-year treasury yields are up 5 basis points today. Really not a big deal. 10-year treasury yields are still pretty muted compared to where they were just, a couple of weeks ago. 10-year treasury yields at 4.275%. 30-year yields are close to 5% now. So you can see we were close to, 4.5% back on July 15th. You're still down like 23 basis points from that point. What's fascinating today is what's happening in the bond market globally. European bond yields are surging. There's some speculation that France could be on the verge of collapsing soon. So obviously in that case, bond yields would skyrocket in France. And it's having a little bit of a sympathy reaction to other countries as well in France. Like the UK, their bond yields are hitting like a 27-year high. Okay, so it's not just the US. There is a little bit of a problem going on in Europe as well today in the bond market, which again, mix that with a weak September seasonal effect in markets. And yeah, you have a little bit of extra selling because of that. Here on the day today, we did get ISM manufacturing PMIs that came in at 48.7. The forecast was around 48.2, so that was a little bit better than expected. Employment came in at 43.8, better than the expected 43.2. Construction spending month over month came in line with expectations at negative 0.1. New orders came in at 51.4. The expectation was 48, so that beat. And prices came in at 63.7, which finally came in lower than expected. The expected number was 65.3. So when this actually came out, the markets rallied quite aggressively. Now, that obviously gave way later into the trading day because manufacturing is only like 20% of the economy, roughly. But this was a step in the right direction, okay? Especially that prices paid number. Now, coming out later this week, we have the services PMI that will be more important. Tomorrow, we have JOLTS job openings, expecting a slight contraction there. On Thursday, ADP employment change, ISM services PMI. Again, if prices paid comes down for services as well, that's going to be a big positive. But again, it's really hard to tell how the markets are going to respond to that in a month like September. Now, Friday, you have the jobs report and the unemployment rate, which is really what people are going to pay attention to. As I talked about today in the trading community, like Trump fired the head of the BLS recently because he said the numbers were rigged and not real. So I think it's in Trump's best interest to get us a positive number. Like if what Trump was saying was correct, we're going to have a surprise to the jobs number, right? It's going to be a slap in the face to Trump if we have a really low jobs number and he just fired the head of the BLS. Like, so again, whether the data is correct or not, it's in Trump's best interest from a let's not be humiliated standpoint if we have a good jobs report to report on Friday. And that should be taken as a positive for markets. Here you can see today, Japan, their 30-year yield jumps to 3.25%, its highest level in history. So it's Europe, it's Japan, it's the US, all bond yields are kind of exploding today. And the US is on the lower side of it. Some countries are going up even more. Now, as Liz Ann Saunders says, September is historically the worst performing month for the S&P 500 since 1928. The index was down on average over 1%, posting gains only 44% of the time. By far the worst month for stocks. So the algorithms are already, again, programmed to not buy stocks, to sell stocks whenever there's even the slightest bit of a problem or uncertainty. You can also see today the delinquency rate on U.S. commercial mortgage-backed securities for offices spiked to 11.7%, an all-time high. So again, add this to the list of worries that Wall Street has, and yeah, I'm not shocked today's a red day. Now, as Seth Golden says on X, the SPX has achieved 20 all-time highs in 2025. When the SPX has achieved at least 20 new all-time highs, it has never stopped there and always, 100% of the time, achieved at least 2 more new all-time highs in the calendar year. The probability of more new highs by year end, including duration, is 91%. So the odds really do favor a strong end of the year rally. Now, Besson said today that Trump may declare a national housing emergency this fall to address soaring prices and shrinking supply, which I think is one of those sleeper catalysts. If we can get real estate that starts to move again, there's going to be a lot of equity that gets taken to people's bank accounts, and that's going to fuel a lot more spending power capability in the economy next year. The Fed reverse repo facility only came in at $21.07 billion today, the lowest since 2021. This is also contributing to some of the bond yields rising because this is the extra money at the banks that gets parked at the Fed. Okay, so it's dwindling. And this is essentially what kind of dictates how much quantitative tightening the Fed can do, how much balance sheet runoff the Fed can do. As this number gets closer, like, honestly, right now, the Fed probably is looking at this number like, oh shit, we need to stop our balance sheet runoff. Like, start being a little bit more accommodative from a balance sheet perspective. Now, Evercore's ISI Julian Emanuel sees AI, fiscal stimulus, and a dovish Fed fueling a historic bull run, with the S&P 500 potentially hitting 9,000 by the end of 2026. What the I can't even believe I just read that. What the fuck? Oh my gosh. I don't know what that would be on a percentage basis, but that would be just crazy. That'd be a 41% rally between now and the end of next year. Holy schmoly. Okay, he raised its 2025 year-end target to 6,250 and projects 7,750 by 2026, calling near-term pullbacks buying opportunities. But Emmanuel warns the boom could end in, quote, the biggest bubble ever, as stretch valuation, sticky inflation, or weak growth could drag the index as low as 5,000. He argues AI's impact could surpass the internet, but stresses that risks remain. I respect the view, okay? I also think AI's impact could surpass the internet over time. But he's saying things could get real frothy here soon. And again, if you're positioned now and the S&P goes to 9,000 or anywhere close to that by next year, yeah, come on. You're going to need to take something off the table. That would look a little bubble-ish. And as I've talked about before on this channel, I think from October, November, December into 2026, I've talked about this many times before. This is like not a new thing. Maybe this is validation to some of my thesis, but I've said before on this channel many times, I think we could be entering into a euphoric market, not a bubble market, not like 2021 where even shit companies are going up, but like good companies that are executing, that are growing, that are profitable or getting close to profitability will excel. Okay. There's a difference between like a bubble market and a euphoric market. Pulte says we have received video proof that Lisa Cook declared, quote, primary residence is being rented out to tenants. Also in the news today, the U.S. holds off new China trade threats amid ongoing negotiations. NATO envoy Whittaker says Ukraine war factors into talks as Russia sanctions are weighed. NVIDIA says they have ample H100s and H200 supply to fulfill all orders without delay. Notes H200 sales don't affect other products and dismisses supply rumors as false. Now, the Atlanta Fed GDP Now tracker was at 3.5%, but did get revised lower to 3%. And again, some of the numbers that we were talking about on Friday, the real personal consumption expenditures growth was revised down to 1.7%, still a healthy level, and gross private domestic investment growth declined from 6.1% to 5.3%, but still a very healthy number. Now, again, alongside what we mentioned earlier with bond yields just rising, you could see UK's 5-year CDS, that stands for credit default swap, rises to the highest since late May at 19 basis points, up 1 basis point from Monday's close. France's 5-year CDS, again, rose to the highest since early May at 39 basis points, up 1 basis point from Monday's close. And Turkey's 5-year CDS rises to 272 basis points, up 7 basis points from the previous close. So Like across the world, bond yields are rising today. Now, again, CDS, credit default swap, just means this is insurance against the government failing. So yeah, it's not a great thing to see. Again, to conclude today's episode, guys, you need to remember, as we talked about over this weekend, like there's going to be news that could be impactful. Revert back to earnings and multiples. Like, is this tariff refunding news really like bad? No, it's going to mean less inflation, better economy, higher earnings, more rate cuts. Okay. Is it going to mean a higher deficit? Yeah. Does that matter in the immediate future? No, it doesn't. Okay. Well, Wall Street can freak out about these things because there's uncertainty now. The reality is this was actually good news. And if this news came out a month ago, stocks would have done well on this, right? So you really have to put these things into different categories. Now, again, there is a bias to sell stocks in September, and that may continue. But if you are a real investor here and taking this seriously, you're going to see through the bullshit and you're going to get rich from it. And that's really the bottom line. Okay. So I want you guys to be prepared for weird shit to happen in markets and for it to not make much sense, right? That's just September for you. But as we get into October, November, December, what really matters, again, is how's AI doing? How's the economy doing? How's inflation doing? Are we going to get Fed cuts for the right reason or the wrong reason? Those are the things that really matter. How's trade going, right? Like, are we going to have lower tariffs? At this point, I view it as if the Supreme Court shuts down Trump's tariffs, great, right? That's positive for the reasons I mentioned. If they don't, fine. We were already expecting they were going to stay approved. Okay, so you're almost setting yourself up for a win-win scenario in markets. Okay, so hit that like button and subscribe to the channel. Check out that link down below in the description of this video if you want to come join the trading community. Again, what we're doing over there is going out finding small cap AI stocks before Wall Street figures them out. Okay, before Wall Street understands what they're doing. One stock in particular, I have over $100,000 invested in that I think is literally a 10, 20, 30x plus opportunity over the next 1 to 3 years. Very confident in that. So yeah, check it out. Not a recommendation, not financial advice. Contact financial advisor and read the disclaimers, please. You guys have a great rest of your day, and I will see you in the next one.